Welcome back, everyone, to our monthly FinTech podcast for This Week in FinTech. I'm really excited to be sitting here today with Drew Edwards of Ingo Payments. So Drew is the CEO of Ingo Money, a company that he founded in 2001. Under the Ingo Payments and Ingo Money brands, the company has become a leading provider of embedded payment and check solutions for fintechs, banks, and businesses. Before starting Ingo, Drew established Town Services, a publicly traded e-commerce company providing solutions to over 1,000 financial institutions, where he served as the CEO and chairman of the board of directors. His earlier career before starting Town was management positions at the Federal Reserve Bank and the Bankers Bank in Atlanta. And he additionally serves on the board of directors of Skylight Financial, one of the nation's first payroll card companies, now owned by TSYS. Drew, thanks so much for joining us on the podcast.
Thanks for having me. Appreciate it, Nick.
It's great to talk with somebody who's really seen so much of the fintech journey since before fintech was even really a word for most people. It used to be just fin without the tech. But I feel like you've had a front row seat and a building seat for a lot of the introduction of tech into the financial services world. And so there's a lot that we'll dive into in learning more about how Ingo works and what you offer to your customers today. But I'm curious, just even before we go into the company and your background, was there a point where you realized that you were going to be a fintech or a financial services person? Was this always the goal? Was this always the dream? Or how did you really kind of start in your fintech journey?
By accident, I think maybe by a lot of people, right? So no, I went to college just to get a degree so I could go in the Navy and become a fighter pilot. That was my focus and mission and dream, right? And it was before Top Gun sort of messed everything up by making everybody in their world want to be a fighter pilot, I guess. When that didn't work out for physical reasons, I landed at the Federal Reserve Bank in a management training program in Atlanta, which is a great place to start and a terrible place for an entrepreneur to be inside the Federal Reserve Bank. But it was that 3 years that got me associated with banks. Helping banks, working with banks, financial institutions. Then one of those banks, Bankers Bank, hired me away. And that's kind of where I got into what's today called, it was correspondent banking, right? But it's the same as FinTech. We were providing tech, software, and other services to banks, as a bank. When I went public with Town, we called it e-commerce back then. So e-commerce means something different today, but back then, if you were helping banks, do payments or finance receivables, you were an e-commerce company. So I don't even remember when financial technology or fintech sort of came along. But the only thing that I have known for sure is I'm not a regulator and I'm not a big company guy. I've got the entrepreneurial disease, so I just keep repeating myself on that. And banking and financial services and technology, the intersection of those just has become natural to me. So yeah, I've been here since the old guys, I guess.
Well, I wouldn't count yourself out. It sounds like you're still building innovative products. And I think we could all use a little bit more experience and a little bit more perspective on, where technologies come in the fintech journey. If I'm reading it correctly, you started Town and 5 years later took it public, and Town enabled electronic transactions for 1,000 FDIC insured banks across 45 states so that they could offer accounts receivable financing to small businesses. Is that an accurate characterization of Town?
Yeah, but I'll give you a little color. The reason it's called Town, because it didn't start out as Town, is, I started that company after developing personal relationships with about 800 community bank CEOs as we were doing the Bankers Bank thing. And you just get to know them all. And I'm like, I've got to be able to do something directly with these folks. I'm driving around in small town Georgia, which is where Town comes from, with these bankers, and we're going out to dinner or going to play golf or going fishing or whatever it is we were going to do. And invariably they'd stop at the gas station, pick up a 6-pack of beer, and they'd just say, put that on the bank's account. He's with the bank, right? And then next thing you know, we're having dinner and they're like, put this on the bank's account. So what I began to realize is this notion of private label house accounts still was alive in 1995 in small towns in America. And it was a burden to the small businesses and an opportunity for the bank. So we built a point of sale platform where they could do what we began to call town credit. Put it on the bank's account. It's just town credit, right? And those systems would all upload because it was sort of pre-web, pre-internet. It was right there on the cusp of it. They would dial in and feed that data into our systems, and we would buy those accounts from the bank, from the small business, and share in the revenue with the bank. So it wasn't traditional accounts receivable financing. It was the original sort of payment processing for us. It was, hey, they want this payment type called town credit, right? And some people, strangers walked in with a Visa or a MasterCard. They would take a check, but everybody that lives in those towns just put it on the account, right? And so we were just digitizing them and financing them for the small business across the country. It was cool. Well, it was hard convincing Wall Street that still existed in America, even in 95.
Well, you were ahead of the game. I feel like Intuit, QuickBooks, Bill.com have taken a page out of your book and now really scaled that to the masses of businesses. But they came along much later. I'm curious, what was your experience like taking a company public during the first .com boom?
Well, horrible and life-changing and fun all at the same time. I mean, the process of going public is a lot of fun. The process of being public is a never-ending grind, especially during that day when you're not ready to be public, right? If you're FIS or Fiserv and you're public, because you know exactly what the next quarter looks like before you get there, that'd be one thing. But we were in this hyper growth mode where I had 400 employees, that 300 of which had been with me less than 6 months, and we were growing so fast the paint wasn't even dry on the furniture that we were sitting on, so to speak. So it wasn't any fun, to answer your question. It was successful. I didn't miss a quarterly expectation while I was running it, and we ended up selling it. Ultimately, it went to Jack Henry, I think 2 acquisitions in, but it wasn't successful in that we weren't a good public company. They had to sell it because it was too big a ramp. And all around me in Atlanta, my peers were dropping like flies. I just happened to be, the first. Most of my investors made money. If you bought in late, bought high and sold low, you didn't. But the public markets are not a source of venture capital. Let's put it that way.
Yeah, no argument there. But I would say, never missing a quarterly projection probably puts you head and shoulders above most of the companies that went public around 1999. So,
but they missed it the quarter I left, and that wasn't. I'm not taking credit for that. I'm just saying it was inevitable. We couldn't keep up the pace we were on. It's so old now it doesn't matter, and it would blow people's mind today. But when we went public, you do a red herring, which is a S1 effective, essentially, right? And you're out there pitching these 25-year-olds, and you get 20 minutes to do it, and you're flying around the country on a private jet. And my revenue in 98, when we went public with a $200 million market cap, and we raised $35 million, my revenue was $780,000, trailing revenue. They're laughing at me, like throwing the book across the table. I make more money than you do in revenue, right? But we got it done. We were oversubscribed, and 12 months later, we did a secondary offering, and the revenue was $35 million. So it's that kind of slope that's just not sustainable, at least not in the company I had built. So that was my first big post-corporate entrepreneurial lesson right there, is all sources of capital are not the same, and better off to get smart capital than unforgiving capital, which is what the public markets are, right? And this is all before Sarbanes-Oxley and all the current, we had to deal with what was called fair disclosure back then, but there was no such thing as Sarbanes-Oxley. I think it might be in jail because we were doing it by the rules back then, but the rules have changed since then. So you couldn't even run the business the way we were doing it then today. So anyway, it was great. It's a great learning experience. Left and went away to the Bahamas and kicked around for a couple of years until a new idea sort of came along.
Well, $780,000 of revenue to $35 million in 12 months is definitely a pretty impressive journey. And it sounds like it led you to the next aha moment, from driving around with bankers in small town Georgia to founding Ingo Money and Ingo Payments. And so We'd love to hear more about that founding journey, but maybe just before we even dive into it, for the benefit of our listeners and our readers, I'd love to understand, really in your words, what is Ingo Money? What is Ingo Payments? And I know that these are effectively two separate businesses. And so we'd love to just hear kind of the overview from you of what these two businesses are.
Well, let me clarify that for you, because it is quite confusing. It's one business, it's one company. The reason we've separated the brands is it's confusing to everybody in the market. And from an SEO standpoint, we have so many consumers that are customers, so many inbound web hits and searches and all around, can I cash my check? How do I get my money and all, that it buries the more modern go forward payment side as far as Google's concerned. So it's one company, it's one P&L, it's one business. But we've had to separate the go-to-market brand so that Google can stay over here with Ingo Money and let it be the check thing, which is still a growing part of our business and important to us. And it's part of the core proposition of helping consumers fund their accounts, right? So money in and money out is what Ingo is all about. We call that money mobility at Ingo Money. So if you have a bank account, for example, you expect as a depositor to be able to put money in it from cash, at a teller line and an ATM machine, from checks, take a picture of your check, from maybe moving it in from Marcus into your account, right? So that money in, we power for non-banks out there. And you expect to be able to pay bills with it. You expect to be able to pay your friends with it, P2P, bill pay. You expect to be able to move money back to Marcus or Robinhood or wherever you want, right? So Ingo Money is the original account funding for the checks. And to this day, we're built into PayPal and Venmo and Green Dot and NetSpend and ADP and everybody out there in the market. And that's really a heavy risk management play for us because checks are so risky. People need good funds, right? Ingo Payments was built on the notion of, okay, all of these consumers that are clicking on cash my check at PayPal, that means they didn't want the check. They're trying to turn the check into a deposit at PayPal, real money, right? So we have this platform, which we partnered with Visa on because they were trying to get the check cashers out from between them and their prepaid industry. Green Dot and NetSpend were going public. They had hundreds and hundreds of these prepaid companies out there. And so the notion there was, hey, if Ingo can underwrite a check from a picture in real time, let's give them this OCT transaction that nobody's using in America. That was the original credit transaction. And that today is Visa Direct, right? And it was, hey, Drew, if you can underwrite that check and we'll buy it, we'll give you a transaction where you can put the money directly into the consumer's account, wherever their account is. And that became the first use case. So we built a platform to do all of that. And then we realized, hey, why don't we split these two apart and go to the corporate entities that are creating these checks, that are sending them out to consumers, and empower them to just ask the consumer before they go to the expense of sending them a check that they again got to go cash or deposit or change or do whatever, right? Let's ask them where they want it and let's give them choices. And so that's where Ingo Payments evolved, because it was, okay, regardless of what the source of fund was, over here Ingo Money, the source of funds was a check. Over here on Ingo Payments, the source of funds is generally an account somewhere else, a corporate account, or a me-to-me account, and we're just doing the, hey, where do you want that money? Does that make sense? So it's one company, but for marketing reasons, one is associated with consumers because those are our customers on that side, and the other one is a pure B2B to C play. If that makes sense.
So to say that back to you, maybe in as condensed a way as possible, what Ingo provides is a single point of integration that allows you to translate between different payment methods from the start point to the end point. Even if it's just a me-to-me transaction, you actually provide the reconciliation and the translation between different payment methods for pay in and pay out.
To do what we do, and this is the difference between us and a lot of people in this space today, right? You have to connect all the networks, right? So there's a lot of companies out there going, one API, any payment type, right? One API, any payment rail, because they are software forward, developer forward kind of shops They're focused on stitching together a myriad array of different rails and networks to enable this movement. That's our Ingo Payments Gateway. That's part of it. But beyond that, moving billions of dollars is risky, especially inbound funds that can be clawed back, et cetera. So the risk management component that was the core of our DNA is probably more important than, we're better than anybody at making these network rails work, especially the card rails, but you got to do it safely. You got to put risk management around it. So even on inbound, like I've got an account at Chase and I just opened a Moneyline account. You know, they're not on this platform, so I'm using them metaphorically to keep everybody confidential. We'll enable you to pull money from that Chase account into that Moneyline account, and lots of companies will do that using a Visa AFT or a MasterCard AFT transaction or an ACH debit transaction. The difference is we'll risk management and even guarantee it so that you know it's good funds, just like we do on checks, right? So you have the gateway and you have the risk management. And then the third component is we build digital experiences. Lots of our clients are people like Liberty Mutual, Geico, Caesars, et cetera, that may or may not want to build a digital experience for their customer to manage all this. And so we have white label experiences so that where you were sending a check, you can send an electronic request, bring them into a branded pay me, money movement environment, put risk management on it and make it all happen without the corporate client having to build all that. And that's Ingo Payments, the software, the gateway, and the risk management. And it's unlike anybody else in the market doing that today.
Well, it definitely jumps out to me that, this company's been around since 2021. It's been scaling since then. You really started a fintech company before fintech was even a word. Even PayPal, which was started in 98, didn't spin off from eBay until 2015. So this company has been around providing payment services for a much longer time than digital payments have been available through most of the providers that we know today. I'm curious, and the reason I bring that up is because I'm sure over those 23 years, there have been some notable inflection points where your focus has changed, the company's changed, you've expanded. I'm curious, what do you view today looking back as kind of the major points along that journey in which the company really took a leap forward? What's changed the most since you started in 2001?
If you knew me, I'd probably tell more than I should, but they weren't all leap forward. Some of them were leap sideways to dodge a bullet and survive, right? So we've had a couple of pivots along the way. We didn't even talk about it, and I won't go into it, but we started as a Hispanic bank in Atlanta. So we actually had 12 branches, and that's the first phase of this company was serving these Hispanic immigrants. And oddly enough, that's where I discovered the need to cash check. Was all of these immigrants were coming in the door trying to send money home or pay a bill or get a mortgage, and they're standing there with a piece of paper that needed to be underwritten, right? So we had to build technology to do that, to run the bank. And so first phase, the bank, we sold it. It started in 01, sold the bank in 08, kept that risk management platform. I didn't want to be in the actual regulated, that's capital intensive, hard to scale kind of business, right? Started offering the capabilities we had proven out at El Banco to other banks and non-bank providers, right? And that's sort of phase two, and, got profitable and life was good, except we were still making money on checks, and I knew that was going to go away someday. Now, let's be clear, it hadn't gone away yet, and it probably won't go away before I'm planted into the ground somewhere. But in a lot of people's mind, they don't care anymore, right? We're in an odd last couple of years where all of a sudden everybody's asking about checks because they're trying to be neobanks and they're realizing their customers are going, what do I do with this? Right. And the fraud has gone through the roof and it's a big problem and we can solve it. But generally, the 25-year-olds running the money don't care about the checks. Right. In fact, they don't even think I called on Jack Dorsey's org when he was early. I've been there 3 times, still not a client. Right. But the first 2 times it was, Jack doesn't think checks are relevant. Right. Now, rumors in the market, and it's just a rumor in the market, that they're out trying to solve for checks because PayPal and Venmo did, and Chime and others have, right? So the checks, we had to figure a way to get away from, and that was the second sort of pivot to, okay, well, let's break this apart and go kill the check. Let's break this apart and go empower corporate America to offer choice to the consumers. And that's about when the clearinghouse and real-time payments and all people are starting to talk about all this. Push to card was brand new. And that's when we brought in institutional capital and money from Visa and just went all in on, all right, let's create choice here and let the consumer kill the check. Ask me how many people still choose a check, though, because that'll...
How many people still choose a check?
It's about 7-8%. It must be generational, right? So give them a choice. 7 or 8% will tell you to send them a check. And so oddly, we get a lot of inbound requests from some of these big giants because they're looking for a complete set of choices, and none of our competitors produce checks. We'll actually send a check.
Yeah, I remember when we were building the card company that I was on the early team at Pedal in New York, we had to actually work with the check processor as a third party that was able to set up a mailbox, receive checks on our behalf, OCR them so that we had a record of the check, and then actually process the payment so that customers had the opportunity to pay down their credit card balances with checks. And it was a surprising amount. I think you're right. A lot of people still use payment methods that have been around for a long time, even though all the hype is around whatever kind of the new payment method of the year is, whether that's FinTech or something even more exotic. Checks are still, alive and kicking in the U.S. And that actually brings me to a key question that I wanted to ask you on this podcast, which is, thinking about where Ingo is today and where the FinTech ecosystem is today. What are the key challenges in the payment solution sector that Ingo still addresses today and that you view as kind of the next hurdles to clear and where you want to bring payments continually forward into the future? What are the key challenges that you're still seeing in the payments market?
Well, we play in this spectrum. We're very horizontal as a company. Like, TabaPay is all FinTech and One Inc is all insurance. And, and FIS is mainly just financial institutions, and Fiserv, but broader than that, right? Well, Ingo is more like FIS and Fiserv, and then we don't have one vertical that we sort of specialize on. So that answer to your question varies a bit there. On the FinTech side, they're looking for the same thing they're all looking for. How do I enable as cheap as I can these money flows in and out? And they may or may not even respect the risk associated with some of those transactions. So we're getting a lot of demand from people that have tried AFT, for example, elsewhere without risk management and are coming in going to help, right? But if you go to the other end of the spectrum to a big corporate, smokestack company that's got a treasury department that's producing checks, millions of checks, they have a different set of challenges. So on the FinTech side, the challenge right now is they're dropping like flies because, go back to Silicon Valley Bank and on forward, the funding dried up on a lot of those business models, and ones that weren't proven out are falling apart. So we don't like that end of the market startup wise as much because you don't know which ones will make it or not. We like FinTechs, but we like the proven FinTechs, the ones that have volume, right? So the challenge there is just their funding and their viability and them staying around. And now in today's world, the compliance aspects, because everything's under scrutiny because of what's happening with banking as a service, and 25% of the sponsor banks under a memorandum of understanding out there with the regulators or a cease and desist. So we'll talk about that in a minute. But on the Fortune 100 sides, it's process change that's required. And those are the big hurdles. So even though they know they want to get off of checks, even though they know what they want to modernize their payout experiences with digital experiences, and even though we can give them a turnkey platform where they can send us an API and we will turn it into a digital experience for their customer, right? They have multiple tech stacks that are legacy tech stacks where all the data you need to make that transaction work. When all they had to do is put a name, address, dollar amount, and invoice number or some other sort of identifier on a piece of paper and put it in the mail and they were done. It didn't need to be in one system, right? The IRS today works that way. They upload stuff and send it to their partner banks. Well, so it's still a challenge on that big corporate side to get their resources lined up to modernize what they need to modernize to be able to consume a digital payments experience. And that's still going to take years for, they're the ones producing the billions of checks that are out there, and that's going to take years. I would say the current regulatory environment is working in our favor because a lot of people are in trouble. A lot of the when you're the old guy like we are, and you've been around a long time, you tend to be perceived in those hot market times as not a unicorn and not the latest, greatest, with all the fancy buzzwords, and you don't have Andreessen on your balance sheet. You don't have all this, right? And everybody else looks sexy, and Ingo looks like a small FIS, right? Like, well, but the world changed now where it's all about safety, and it's all about, well, wait a minute, these old guys might be the safer place to go. So we are known in the market as the guys that know how to do banking right. Banking as a service. The banking piece is the part that matters, right? And the guys that have been around a long time through all these economic cycles, and who have clients like, when I asked Caesars, who's one of our clients, why did you choose Ingo? Like, we weren't even in that space, and you have all these different options in the gaming space. Why did you choose Ingo? And their answer still resonates with me, which was, he said, well, we weren't enamored with our current partnerships, right? And so we were looking broader than that. We looked at Ingo and all the other suspects, and we felt like there's that Ingo who is big enough, they've been around long enough that they're not going away, they're done raising money, but their client base are all these big brand names and big companies, right? And so that felt safe to them, right? So that's sort of our lane. We don't win as often the straight FinTech, you can leave that to the Moves and FinXs and, that part of the world out there, right? That's doing that. Where we tend to win is when you got a mature company or a sizable FinTech that's looking for scalability and resiliency and risk management and compliance, and an org that does it right. I mean, I got 250 employees, and 3 or 4 of them are lawyers. We do a lot of regulatory stuff around here because it's the only way to stay out of a ditch when you're doing payments, especially embedded banking. And we're jumping into this BaaS space with both feet and both arms, right? So that's who Ingo is, and it's really paying off for us now because we got to stay in power.
What are the turn numbers that you can share end up looking like for Ingo?
Honestly, 3 clients I can think of that were acquired by somebody that had their own platform, right? And 2 of those 3 were on the check side. So on the payment side, we've had some go away, like literally go away. Some of the FinTechs that just didn't make it. We have to rebid with our large corporate. Every time the contract ends, there's an RFP that goes out and you have to re-win it, right? So, but we haven't, knock on wood, lost one of those to a competitor yet. And since we've been doing this, I think we have a lot of volume. So we have super competitive network pricing for most of what we do. I don't think that's why people stay, though. I think they stay because, especially if you're an enterprise, we just know how to support you and we know how to partner with you. And that's important. That's back to the Caesars magic, right? We actually take care of them and are helping them grow, and it's a partnership. And we hear all the time, we're laying out performance numbers and where the problems are, and which banks you're seeing failures or returns from and all. And they said something one time like, I'm trying to keep the sanctity of confidentiality, but we've heard this from multiple clients. They said something like, well, that bank right there is always a problem. And we said, yeah, you want us to turn it off? And they're like, what? We can turn them off. Our system, we control our own routing. We can control where we send it, how we fulfill it, and if we send it right down to the merchant and the bin level, even the dollar amount level. So I said, your other partners don't do that for you? No, it's like on or off. I said, well, you can tell me you don't like, as long as it's not an illegal reason, you can tell me you're scared of banks in Oregon and we can turn them off. Now, the networks might get mad about that, but I think those kinds of interactions and relationships are at the core of our sort of, our clients want to understand how this is working, and they want to be comfortable that they're optimizing it and that they're safe doing it. And today where it's mostly about moving money for them. Tomorrow it will be embedding new accounts for them so that they can begin to monetize some of these payments and not just make it a cost center.
Okay, so that actually is very interesting. And I'd love to hear a little bit more about the expansion into what I guess today you would call banking as a service, although I think that that's a little bit of a catch-all term, maybe not as appropriate. But that Ingo owns its own routing is really interesting, that you have the opportunity to turn on and turn off and channel payments specific to banks, specific to BINs. I think it is something that is not very common with payments providers today. And so I'd be curious to hear from you, what are some recent advancements, innovations, and product launches that have come out of Ingo that you're really excited about and that your customers have gotten excited about that you've launched recently?
One of the top ones right now is this applying risk management and guarantee to inbound card transactions and inbound ACH transactions. So that's, and I don't mean like a purchase transaction. I mean, I got money at Chase. I just opened, this neobank account and I want to pull $500 in to the neobank account. Huge fraud problem. That's just asking for trouble, like with checks, right? So we know how to manage that. We've got our own, I'm not going to use the overused word of AI, but we've got our own models and machine learning and data scientists, and obviously AI is becoming a part of that. But we've got experience at managing this kind of fraud, and we've got some partners that help us with that, and that's getting a lot of traction because it's a needed piece of functionality. One of the biggest costs of any kind of new account issuer is they go to the expense of underwriting and opening an account, maybe even some of them send out plastic, and then it never gets funded and it goes away. It never gets sticky, right? So, or it gets funded, but then they're gaming you, they drain the money and it gets clawed back later and they're gone, right? So that's very important to us. Right behind that, I have been preaching against this for the last 20 years and now I've changed my mind. I have been for this whole time been saying no consumer wants another account, right? They've got plenty of accounts. They want to choose between the accounts they got, to get their money. I get a $250 rebate from AT&T. Don't force a new prepaid card on me I didn't want. Just send me my $250, right? So, and we have some clients now in that incentive space, for example, that do that. But there are cases where I was wrong, and what we call, so you made that comment at bank as a service. I'll tell you how we're thinking about this, though. Let's start with issuing as a service. Forget about the bank, because you are banking, but banking as a service is like a platform sale to somebody who is trying to build a neobank or something. But within our ecosystem of paying out money, like we have hospitality clients where we're paying out tips, we have gaming clients where we're paying out winnings, we have insurance clients where we're paying out claims or recurring payments for commissions to agents and all that kind of stuff. We're calling this sender-centric issuing, right? So these built-in use cases where you got a restaurant that's got 200 waiters and waitresses and just signed on for this. And today, for example, I was a waiter in college. It's still the same, right? They want to leave with an envelope full of cash. They want their tips today. It's a daily kind of model. You talk about daily pay and active hours and all. Well, restaurant work's always been a daily model. When we go into those use cases, there's a couple of problems that we're going to solve with issuing as a service. Some of these workers don't have an account. They're underage, right? And they haven't gotten a green light account yet, but they're underage. I can issue them a new account as a corporate disbursement in that payroll sense, even though they're underage, as long as there's an employee. Now, I'm not going to let them load it from other sources, but I can get them their tips every day, right? And right now, the restaurant is probably charging their workers to go to digital payouts because it's costing them money, right? So we're going to create lower cost ways to monetize that with issuing. So that's just use that one example. You can apply that to insurance, to commissions, to gaming, to college payouts. We've got all kinds of programs where we are, right? So that's the first step is, and we already have the betas waiting on us right now, is to start actually doing what I said nobody wants and giving them a new account for this particular purpose, right? Because it works for them and it's seamless. Take that one step forward. None of these restaurant operators want to become a bank. So they're not looking to be money line. They're not looking to get into that, but they want to participate in the economics. So by embedding this banking into their payout experience, we begin to create revenue streams for them, but we're providing a migration path. If they do get to enough scale that they decide they want to program, manage, and own their own economics and do their own thing, then we can leave them on our platform, turn it into a true BaaS deal, and power it with our technology and our money movement coming in and out. And we don't think this really exists well in the marketplace today. We literally are getting almost universal demand from our clients on that. And then, you could take it one more layer. We've got a platform, we'll be coming to market with it, that also can empower a bank directly to have their own BaaS experience, right? Which is kind of a trend in the market that we'll play into, because with my background, I know how to sell these banks. That's what I've always done. And we're one of those old guys, safe guys, bank-friendly guys, trusted guys in the space. So we think we'll do well in that bank direct space because we're not 2 years old or 4 years old, because we're not a middleman. We own our own tech stack, our own relationships with the networks, or our own risk management platforms. What we're doing here is just embedding new account experiences into our payout choice mentality, right, where it's appropriate. So sender-centric issuing is one of the safer ways to do it. You won't be able to go download an Ingo account and open a bank account just out of the blue. That's not going to happen.
Well, I'm gonna ask about it because you brought it up, and I'm curious to hear your take as somebody who's really seen banking as a service and its evolution even before we called it banking as a service. As you mentioned, there are newer entrants in the embedded banking BaaS space. There are partner banks that have taken on a lot of fintech partners and sponsored big platforms, and perhaps gotten out a little bit over their skis. And so it's a unique moment in that we're seeing some of the pitfalls of fast growth, sometimes poor internal controls, sometimes partner management processes that were a little bit lacking in development. And so I'm curious, what do you think the future looks like for the fintech and banking as a service and partner bank space? I'm sure, these are three different futures, but, where do you see us going from here as a space? And where do you see, regulatory bodies stepping in and either rulemaking or enforcing, kind of what do you think the fintech trajectory looks like from this point?
The notion of whether this is fintech or not, it may be secondary, but the notion of embedding new accounts in customer experiences, right? It's unassailable. I don't believe the regulators can or even want to shut that down. What they want, I've spent my whole career with these banks and their regulators, and knock on wood, have never gotten in trouble along this time because we think like a banker. But what the regulators want is the bank to have control of what's going on, right? To have knowledge and oversight and control to make sure that the I's are being dotted and the T's are being crossed, right? So what we're dealing with right now is a shakeup where banks got into the space, and while we've got these really hotshot fintechs that are doing that, we've outsourced it to them. That's a no-no, right? You don't outsource banking. You can partner with technology companies to do banking in a distributed way, which is what proper BaaS is. So I believe, to answer your question directly, this notion of banking as a service or embedded banking is here to stay and is going to continue to grow. And what we're dealing with right now is a shakeup where banks that have gotten into it without full respect for what they were doing are in trouble and will probably go by the wayside. And fintechs that brought that to the table and didn't keep their banks out of trouble and partner with them will go by the wayside, leaving an even healthier opportunity for the folks that are doing it right. So if you've been watching what's happened, FIS bought Bond and rebranded it. They'll do it right. Fiserv's built their own platform and is in market with it. I hope the good ones survive, right? That's why we're coming into the space. We feel like it's in need of another old guy to do this stuff right and safely. One of the trends I believe we already are there is third and fourth party risk is really hard for a bank to control. So if you're one of these middlemen guys, then you've got all these vendors, and then they've got a vendor on the other side, and then the Visa and MasterCard or somebody else out there. That's a lot of layers to really exercise proper bank oversight. And because Ingo owns our tech stack, owns our integrations directly, and works hand in hand with our banks, we have two layers, Ingo and the bank, both serving the FinTech client of the bank, right? We don't touch consumers' money. We don't commingle money. We're doing it the way it's supposed to be doing it. And people have asked me, how do you know you can do that? Well, because we've been doing that for 20 years. When we cash a check, going back to Ingo Money, we don't actually cash check. We are a FinTech. That is a bank service sitting inside of PayPal. And when that consumer clicks on Cash My Check, they are enrolling with Sunrise National Bank. They become a customer of the bank, and we're the BaaS provider making that happen. Now, we're not opening an account for the bank, but we're making them a customer of the bank, and the rules are darn near the same, right? And so all of our business has always been around, in the beginning, if you remember, running 12 branches for another bank. Like, that was the original banking as a service. We stood up brick and mortar and staffed them and stood across the teller line and opened accounts, right? That's where we started. And then we've been doing it now in partnership with the networks and these big players for the last 10 or 15 years, I guess. It's 2011. And so now to add an actual DDA account or a debit card in there, it's just natural for us. It's just going one more mile in what we're doing, and we'll keep doing it by dotting the I's and crossing the T's and having a paramount respect for the banking piece. As Jim McCarthy said the other day, the banking part of banking as a service. That is, you get that right or you're out of the business. So the players that get that right will enjoy a healthy, growing future here, I believe, in embedded banking and embedded payments. And that's our belief anyway.
Well, I'm curious, pivoting a little bit here because we're coming up to the end of our time. I'd be curious to hear from you. What does the future look like for Ingo? Do you see yourself, you don't have to tell me, but do you see yourself taking another company public? Do you see this?
God, I hope not.
Once burned, twice shy, huh?
What we would do, now my real answer to that is we would only go public if we were mature enough in our predictability of our future revenue streams to be public, right? You need to kind of know what the next year looks like if you're going to be public. So you got to kind of move out of heavy R&D mode and growth mode and into blocking and tackling in that regard. And we're not there. So I had a smart entrepreneur peer of mine in Atlanta who's made more money than me and never stayed in a company as long as I have. But he gave me a piece of advice a long time ago that I've never forgotten, which is just run the company like you're going to own it forever. Like, not the public markets, not the investors, not looking for an exit, not trying to put, lipstick on it and dress it up. Just run it like you own it forever. And we try to do that every day around here. Like, we've been around 23 years. I don't know how long I'll live and how much longer I'll be around. Now, I have institutional investors and they ain't sticking around for 23 more years, right? So if I'm going to run it forever, there could be a recap out there in our future. And if we do that, it's probably about 24 months out from now. We've got plenty of capital. We're not planning on raising any more money unless it's to provide liquidity for our existing institutional investors, right? So we think there's a lot of work to be done here. We're having fun doing it. I think I got the best team in the space, and just upgraded our chief compliance officer as part of this thing. We've staffed up 8 people, in fact, that just focused on this banking as a service stuff because we're taking that seriously. But that's Ingo. We want to not lose any clients and add a few more and make them all happy, and our shareholders will win in the end, one way or another.
And how big is the team today at Ingo?
About 250. I don't know the exact number. 240, 250, and that's split kind of half and half, check versus not check. It's not financially because the payment side of the people are developers and tech people that have one pay scale, and the check side has about 80 some odd hourly people that do customer service and risk management and that type of stuff. So more than half my payroll is on the payment side. headcount wise, it's about 50-50. We run 24/7. And before COVID, we had to run redundant call centers in different climate zones because we operated last year at 5 nines of uptime. If you know what that means, it's rare in the market. Visa operates at 5 nines, I think. And
that's a Six Sigma.
Yeah, that's not, by the way, our SLAs. And we had a really great year. So, but we're always at 4 nines, and we had to run 24/7. But COVID forced us to go remote. I'm still standing in our office, but our call centers. So I'm not a big remote fan, but that has enabled us to essentially distribute hourly customer service and risk management people anywhere in the country across time zones. I don't have to worry about generators and data centers and all the stuff that would go with that, right? We have them working at home. We can see them. We can control them. We can measure them. We can monitor them, and anybody can work here, which is really nice. A lot of them are part-time. So you can have mothers and, people that need to be around the kids. So that's one of the positives of remote work.
And just for listeners of the podcast, 5 nines, if I am getting this correct, means that the platform is up 99.99999% of the time for customers, which is a pretty impressive feat.
99.999% of the time. So we were down. Yeah. And that excludes, there's math and how you do that, right? But that excludes predetermined, regularly scheduled maintenance windows, which happen at like 3 a.m, right? So parts of the platform do get taken down for 30 minutes here and there for maintenance, but our clients know about it. That's not considered a downtime failure. So my lawyer's going to be mad at me, my general counsel, for voicing that, because everybody will start asking for that. We will not commit to 5 nines. That's a little too aggressive. We'll commit to 4 nines, but not 5. But we try to operate at 5 nines. It goes with you've been around 23 years. It goes with your banks trust you. You've never gotten anybody in trouble. It goes with you guys are really good at risk management, and you can't tell Caesars that they can't pay out their winnings, for 3 hours. It can't happen, right? So it goes with resiliency and redundancy, and all of that is fintech and payments.
Just to put that in context, what that means is that if the platform is available for 31 million seconds a year, only 3,000 of those seconds is the platform unavailable, which is a pretty impressive standard to hold to. Last question. I know we're getting up on time here, but a lot of the hot fintech companies of the last couple decades have moved to or started in San Francisco, Los Angeles, Chicago, New York. But something I think different and commendable is you all have stayed true to Alpharetta. And so I'd be curious to hear from you, maybe as a pitch to potential hires who are listening to the podcast. What's the Atlanta and Alpharetta tech scene like, other than having great barbecue?
Well, remember, we're technically a financial technology company, but we're a payments company, and Alpharetta is the payments capital of the world. So this is the Silicon Valley of payments. Last time I saw the propaganda out of the ATPC, the 60% of all payments flow through Alpharetta, Georgia. You got to remember, First Data's here, FIS is here, Fiserv's here. They're not all headquartered here, but that's where the core was. Atlanta, for some reason, Global Payments was here. Paul Garcia is a shareholder of mine. The whole space is here in Atlanta. So we draw on the payments talent, and they're literally down the road from us. Georgia Tech's an awesome school. There's a lot of talent here, and with work, none of them want to drive to Alpharetta. They want to be down in Midtown where Rob and Catherine and Cabbage were, right? But now they don't care because it's remote work. So without a doubt, Atlanta, for whatever reason, is just an awesome place to live, and one of the top, number 3, I think, in the country in Fortune 500 headquarters. But it has not had a good venture capital scene. It has not had. I've never raised really any institutional money in Atlanta. There's now money in Atlanta, but it's foreign firms from other states coming in and setting up, right? But the city and the workforce, I think we're at 7 or 8 million people, and if the traffic's horrible, The climate is mild 4 seasons with an unbearable June and July and August, right? Going to be 103 this week with a 98% humidity, right? But most of the year, I get off planes in Minneapolis and other places in the winter, and I go, oh my God, why do people live up here, right? They get off the planes in Atlanta and they go, what is wrong with y'all, right? We're like, it's better than Houston. I mean, at least we're not in a swamp. We actually have employees in Silicon Valley. I'm paying taxes in 17 states, but we don't have any trouble finding talent in this city. It's a great environment for payments companies, especially because I can almost always hire somebody that came from the payments industry here. Maybe not AI people, they're all coming out of Stanford, I guess, over there. But the beauty of work from home is I can hire them. Cost of living here is a whole lot less than San Francisco.
Well, you may not have heard it here first, but you heard it here the latest. Atlanta, payments capital of the world. Ingo Payments is hiring, so go look them up online. Ingo Payments. Drew, thank you so much for stopping by and talking with us today. Really, really appreciate having you on the show.
Thanks. I look forward to following your work as you go forward.